Good morning all and welcome to another one of my videos. I have two pairs on watch this morning. Those are West Texas oil, that's easy for me to say, and pound kiwi. So I'm going to break them down for you now. I've just taken euro yen off of watch because it looks like taking a little bit longer to shape up than it previously did. Of course, it may not shape up at all, and that's one of the important aspects of trading is to remain neutral. Okay, the minute you're not neutral and you think, yes, this will happen, notice I put emphasis on the word will, then you blindside yourself, you put the blinkers on, and you block out anything which doesn't confirm with your bias. That's called confirmation bias, which prevents you from being able to learn new things. So it's quite important to stay neutral and to not, you'll notice I never use words like will, the market will do this, will do that. I don't know what the market's going to do. I know what I've seen in the past. I know that these patterns that we look for repeat themselves consistently. But the moment you think you know what will happen, that's a slippery slope in my experience and opinion. So without further ado, let's break down these pairs. To West Texas oil, if you've been watching my previous videos, you'll know why I'm looking at this pair. But for those that don't and those that are new, I'm going to break this down for you now. And if you do watch my videos regularly and you think he just says the same thing all the time, good. The way to get good at anything in life is through constant repetition. So if you're seeing the same things in your chosen field of expertise the same way over and over again, it means you're consistent. Your mental process is consistent, and one of the key aspects of trading is a consistent mental process. If it was all about technicals, then surely, given how many intelligent, analytical people actually trade the markets, surely there would be more people succeeding in trading than there actually is. If you've ever listened to Trading in the Zone, you will have heard him talk about the fact that 95% of traders fail. I don't believe that all these people are stupid or technically inept. So what's the key factor? It must be psychology to a large extent. So one of the ways that we keep our psychology primed is a consistent thought process. But you need a strong psychology to be able to think consistently in the first place. But anyway, let's get on with these pairs. So why am I looking at this pair? I'm looking at this pair because we have this liquidity point. Price comes up to it, near misses it. When we near miss a liquidity point, it's often the case that there are still orders up there. Perhaps not if it goes back to 2011, but if it doesn't tap into it, it gets close and doesn't tap into it, it's likely that this is still an area of interest. We get a little bit closer to it, get very close again, don't quite tag it, and then we see the impulse correction continuations, which we who trade the Falcon strategy are familiar with. We then get an impulse down, followed by a very wide correction. When a correction gets very wide, such as this one, the natural ebb and flow, the impulse correction continuations, which we typically see, become less reliable because the volume built up in here sometimes causes price to break to the upside instead of continue to the downside, and we get what we call an M style pattern, which is essentially the clues in the name. We get this M or W style pattern, whatever you want to call it, and then so that was the clue. When this correction got wider and wider, that was the clue for me that perhaps we were going to break to the upside to take out this high here. This one here is a bit too far away, but this one here, tap into that area, and then we start the aggressive move, which seems to be what has happened. And as I said yesterday, the clue for me is that we have this 1, 2, 3, giving me a clue that this is potentially a completed 1, 2, 3 wave. Okay, so as I drill down, as I said yesterday, one of the things that we don't typically see as much is an impulse down followed by a larger correction to start with. So this is a slight anomaly, although it does happen. So we get the larger, normally we see the tighter corrections and the corrections tend to get bigger as we go down. We don't tend to start with a larger one. But anyway, we get a larger correction. Then we get the more tighter flags. This is the daily chart after all, but this is just me pattern separating, trying to make sense of where one structure begins and another one ends. And you can see what we typically see is with these larger structures and then tighter corrections on the break of them. And this is because the volume that's been built up in the larger corrections causes price to not need to correct for as long because the volume has been built up in here. And that's why we typically see the smaller corrections on the break or, floating just outside or within these larger corrections. So you can see we have this larger correction here. This is the daily chart. We have this very clear 1, 2, 3 touch move with this kind of middle section. So this 1, 2, 3, where this is the kind of corrective middle section. Within this 1, 2, 3 move, we tap into this area here and we push down, but we scoot back up. Sometimes this happens. That's why I've not got trend lines, my trend line extended through all the way over here, because this to me looks like a completed 3-touch structure. And what price sometimes does before it commits to the downside after a 3-touch structure is scoot back up for a double top. This might not technically be a double top to those of you who are not familiar with this strategy, but this is as those of us who trade the Falcon strategy are concerned, this is a double top, because what we typically see is price break above. So people tend to think that the double top is off the cards now, because technically in their book this is not a double top. But what we typically see at these standout liquidity points, bearing in mind this is the daily chart, we tend to see price break above rather than just react from here to the downside. And that is because, as I said yesterday, brokers and so forth, news platforms put out information such as West Texas oil at, whatever it is, a 3-year high or whatever it is in this case. This is just a, what is it, a 3-week high or 4-week high, but they put out these kind of statements. You could say, it's at a 1-year high, almost a 1-year high, and this encourages people to buy out of FOMO. Okay, this encourages people to buy. Those who think that resistance becomes support once price breaks above it, believe that this is now acting as support. So you've got the mixture of people who saw this move going without them, thinking it's just going to keep going, people believing that resistance becomes support once it breaks above, feeling the need to buy. And the clue for me, as I said, is these low momentum candles. When we get into this area, we get these low momentum candles, and that gives me a clue that this is not the big players that have caused this move, but rather people getting themselves caught the wrong side of the market for the reasons explained. Just to touch on it, we have a potential, and I do say the word potential instead of words like will, as I've said, keeping neutral. We have a potential hanging man formation on the daily chart with this bullish move up, followed by this low test. So this potential hanging man. So if price was to close below here, this area of value, we would have a hanging man formation. Price could move up to the upside. It is, of course, correcting above the high, but what we typically see above these kind of daily double tops is we see these 4-hour structures. So after a big move like this, if price was going to push to the upside, see, price is either finding liquidity from a hook point such as this, a sharp liquidity point, or it's building volume. Okay, so as I said, people could be getting caught the wrong side of the market, and then this hook point has provided the volume for price to go to the downside. But after a big move up such as this, to move to the upside, price typically needs to build volume, and that would typically look like something like a 4-hour correction. This is the 4-hour chart. It would tend to look something like this. Okay, so at this moment in time, it's not that I wouldn't be looking to get long, I wouldn't consider it, but at the moment, price would need to build volume to get long, whereas where shorts are concerned, this is prime rib at the moment. This is in the prime territory for price to just crash to the downside because of the reasons explained. So with that in mind, what I'll be looking for from this pair today, just tried to provide a slightly different perspective than what I've provided in the previous videos. I don't know why we've got 2 arrows on there. Let's get that off. Let's get that one away. So quite simply, all I'll be looking for today, I'm just going to move this across slightly, is a push down below this area of value. That will give me a clue. If we get a solid impulse down, I did say yesterday that because of the bank holiday in the United States and Canada, we may just trickle sideways for another 24 hours before committing, which may well be the case. That may be what's happened or happening. If price impulses down to the downside, then that gives me a clue that the bigger players, the banks and hedge funds, etc., have stepped into the market. And then if we get a correction afterwards, which is more often than not, just the big players stacking their orders for the next leg lower, then I would look to get short either within or on the break of a flag such as this. And if you look at the level of aggression which price moved up with, typically price tends to give us a degree of symmetry and mimic the level of aggression if it moves in the other direction. So the first kind of real solid inflection point where there may be maybe some profit taking is down here. And of course, if we got that flag, then I would be able to manage this trade for something in the region of 9 to 10%, depending on the size of the flag and therefore how wide my stop loss would be. So that is West Texas Oil. I've got an alert set there just to touch on it. I don't know if I mentioned it at the start of the video, but as I said, I took the euro yen off because it looks to be shaping up a little bit, taking a little bit longer to shape up than it previously did. But I do still have an alert set on that pair at the same area of value. Okay, just in case it happens to get there more quickly than was anticipated. So I'm just going to take that alert. Actually, just leave that on for a second. So, right, excuse me, pound Kiwi. Pound Kiwi, looking at this because we broke above, not too concerned about this because this is just a wick. If we just move to the line chart, we can see that that wick does not occur, does not appear. So that gives me a clue that this is just a volatility spike. But what I'm seeing here is that we have this 1, 2, 3 touch structure, which falls just shy of this liquidity point. Okay, this is non-progressive price action. That's the thing that stands out to me. This is a non-progressive move. It took a very, very long time to get here. Okay, giving me a clue that this is not the kind of structure that we see that that typically just blasts to the upside. And we also have a near miss. There's another volatility spike here, which doesn't really make sense in terms of the grand structure. And again, if we flick to the line chart, that wick does not occur. So if that wick does not occur, then that means that this here is a near miss to here, meaning that because we have a near miss here, price is more likely to gravitate back towards this area. We do break out of this structure. Okay, so that near miss was a positive confluence factor. And then we got what we call an ending structure where we get a 1, 2, 3, where the second touch falls just shy of the liquidity point. I've touched on this in previous videos, okay? This is, again, non-progressive price action. If price is going to blast to the upside and keep going, notice I put emphasis on keep going. We don't typically see exhaustive price action such as this, which suggests that price is going to, just blast to the upside. Or sorry, which suggests that price is going to move to the downside. And this here, as I see it, as I've touched on with excuse me, as I touched on with West Texas Oil, this is just indicative to me of people getting themselves caught the wrong side of the market rather than price actually just blasting to the upside. So as I drill down, I'm just looking at the how price broke above here, and once again, if we just drop to the 1 hour chart, there is an element of direct nature. We do have impulses and corrections. But we also, to me, this looks like exhausted price action. And then sure enough, we get the impulse down followed by that tight correction that I was talking about, which we typically see if the bigger players have stepped in. We get an impulse down followed by tight correction. We get an impulse down. There was another one, a little tight correction there. These tight corrections are very reliable looking structures, okay? If I just zoom in ever so slightly, that gives me a clue that this is the big players doing this. Then we get another correction, and we get this solid 1, 2, 3. There is a correction here on the 5 minute, and this is a really nice looking sequence as far as I'm concerned. So this, to me, as I said, looks like people being caught the wrong side of the market. So the next question I ask myself is, what is the sequence? What does the sequence look like? Does it look reliable? Sometimes, if as with West Texas Oil, if it's the first flag in the sequence, then the sequence is fine because that's the first flag. But when we've already had previous flags, I'm looking at how reliable they looked. Is there any erratic behavior? And the answer in this instance is no. We have an impulse, reliable looking correction, impulse into that tighter one, which I just showed you, into a slightly larger one. And then we have a larger correction. Okay, so this is a nice looking sequence. It is slightly high up. Okay, and it is possible that this could, if we move down from here, we could be forming something like that to push long. But then, as I said, my next question is always, where are we pushing long to? Okay, and if that is a volatility spike, then are we really pushing long to that? At this, it's a long way away. Um, I don't think so at this moment in time, but of course things can change. So what else do we have? So we have this larger correction now. We have this 1, 2, potential 3. Price doesn't always have to get to the third touch, but the area of value is the main thing. When the trend line and the area of value are close, that's a good sign that the price will likely react from here, as opposed to needing to go all the way up to the top of the trend line. Of course, it could do, but what I see here is that we push below here, price reacted, we push below and push straight back up very quickly. That gives me a clue that there was a lot of liquidity here, which would likely push price to the upside, which is what's happened. We also have, just to touch on it, that this area of value, there was a sharp move up followed by a sharp move down. Now, the sharp move up was likely caused by a lot of liquidity being placed in this area very quickly, and the sharp move down was likely caused by the fact that liquidity, those orders were actually filled, which gives me a clue that there will be a lot of stop loss orders just above here, and potentially a lot of limit orders in and around this area by people who understand that there is a lot of liquidity in that area. So with that in mind, what I'm going to be looking for today is the following. Because this is a very, very wide structure, I won't be looking for a risk entry, which is essentially where we look to call the tops with a rejection candle. I do know what I would be looking for if I was looking for a risk entry, but when the structure is very wide, um, I certainly wouldn't be looking for a risk entry from here, because price could trickle up to the trend line before it drops. And I wouldn't be looking for a risk entry from here, because if we were up in this area, then we would be very close to another sharp hook point where there is likely a lot of orders. So what I'll be looking for, with all that considered, and of course this may not happen by the end of the day, but if we tap into this area and we react and we get a solid impulse down, that gives me a clue that there was a lot of liquidity has been tapped into, and that the bigger players have stepped into the market. And if we get that subsequent correction afterwards, then I will be looking for a reduced risk entry on the break of the flag, or a risk entry within it. And even with the wider stop loss on the reduced risk entry, I would be able to manage this down to the first real solid inflection point where there may be some profit taking for something in the region, once again, of about 9%. Of course, if that alert, which I have set just below the area of value, is not triggered, then I won't be looking at this pair at all again today. There's no need. If that's my entry requirements, then why do I need to check this pair if that alert doesn't trigger? I don't. One of the reasons that people lose money is because they keep checking the pairs that they're looking at, and they're in hunter mode, they're searching for entries which don't meet their requirements. And I always think of this analogy as, like, if you've ever looked at clouds, right? And bear in mind, I haven't gone completely left field, but if anyone's ever said to you, can you see that face in that cloud? You probably start by saying, no, you can't. I can't see a face in that cloud. But the more you stare at it, sometimes you go, oh yeah, actually I can see that face. I can see that uh, silhouette of Jesus, or a silhouette of a dog or something, right? The point I'm making here is that the more you stare at price action, the more you will convince yourself that there is actually an entry which meets your requirements, versus if you just set an alert like this and you don't check that pair at all until it reaches your area of value. Okay, that's a good way to protect your psychology. Your psychology is being affected if you stare at the charts constantly and you convince yourself, either wittingly or unwittingly, that there's an entry there which meets your requirements, which actually doesn't. Okay, so it's just an analogy I use to think about trading, and how people think about the markets. But hopefully this has provided you with some value. And of course, as I always say, I will be back tomorrow with another video if I have a pair or more than one pair on watch. But for now, have a great day, and I'll speak to you again soon. Thanks for watching.